So we're sitting here in Sand Hill Road, the center of all venture capital for high tech, for a particular reason. A lot of my friends have been asking me, how does venture capital work? How do you go about going for your Series A? How does that entire process play out? Rather than explaining it over and over and over again, I decided to go ahead and just record myself talking about it so that I never ever have to have the conversation again. So my name is Bruce McFarland. I've been a high-tech entrepreneur for a number of years, and I've been through this process quite a few times. And I hope that you find this informative. So let's get at it. So, you think you want to do a startup, huh? Well, first of all, before we get into any of this stuff, let me start off with the disclosures. I'm not an attorney, and I don't even play one on TV. I have just done this a few times. If you're going to go through this process, you really do need to engage legal representation so they can make sure that you're well taken care of. Also, what I'm going to be telling you has just been some of my more common experiences with the process. There is many different ways of structuring a startup organization as there are startups in Silicon Valley. So this is a general guideline. A lot of what I'm going to be telling you is probably stuff that's going to be shared with you by your attorney, but at least you'll get to understand what some of the principles are, some of the more common misunderstandings long before you walk in there, so you can walk in there with a little bit more education and be structured in the best possible way. Having said that, let's run through a scenario. You and your buddy, you just graduated from Berkeley or Stanford, and you have this wonderful new idea for how you're going to make the world a better place using machine learning analytics to look at big data to be able to whatever. So that's great. You want to start off something, and you're going to need to structure an organization that's going to be attractive. So first thing, if you're planning on going ahead and getting venture capital funding, you're going to want to incorporate. And there's three ways of being able to incorporate. You can do an LLC, which is great if you never plan on getting any additional money in. It's just going to be you and your buddy. But again, this is about how you do a venture capital. So if you're doing a venture capital organization, I'm just going to cut to the chase. So you're going to want to do an S Corp. If you're not structured that way, then when you go out to get your Series A, they're going to want to restructure you that way anyway. So go ahead and get things started off in the way that they're going to want you to begin with. It's just going to make things all that much more simple. Second thing is, how many shares do you want to issue? While it might seem wonderful to like, oh, we're going to go out and you can make that number anything that you want to. You're like, oh, we're going to have 100 million shares, so I'm going to have 100 million shares of my company. And you're like, you know what? And we'll explain this as we go through this particular video. As you start getting more investment, the number is just going to end up increasing, and it's going to end up feeling a little bit like monopoly money. You want to actually start a lot smaller than you would expect. You're going to want, because each round of funding that you get is going to end up altering that number of outstanding shares. And while it might make you feel rich to be, having your paycheck paid in pennies, you really want those larger denominations. So you really want that, that number really relatively small. In the examples that I'm going to be giving you here, I'm going to make things a nice even number that's easy to do math with, just so that we don't have to go through anything unusual or odd. So I'm going to, in the example I'm using, I'm going to say that you're going to start off your company with 1 million shares. Just as an even number. That's probably way too much if you're just starting your company. But again, just from the standpoint of making the math easy as we go along. So you started your company, you've started working, your buddy and yourself, you have a working prototype, you're ready to go out, you have your 1 million shares, and you start talking to venture firms. And we'll talk about what to do there and who to look for in another video. But we're just going to say, okay, you've gone through that process, you go out, you find a VC firm. The VC firm says, hey, we like the idea, we think that you got something really good here. We're going to give you $1 million and we want half of the company. Most people misunderstand what happens at that point. They think, okay, they're going to be buying half of the company, I'm going to give them 500,000 of my shares for $1 million, and that's not how it works. Your million shares are your million shares. You have that many shares outstanding. They're not buying your shares, they're investing in the company, and you're issuing new shares. So if they're getting half of the company, what you end up doing is a couple of things. And it's really interesting because that one offer, if you accept it, triggers a whole bunch of different processes. Number one is you have 1 million shares, they want half the company, you're issuing another 1 million shares. So now instead of 1 million shares outstanding, you actually have 2 million shares outstanding. They have 1 million shares, you have 1 million shares, they just dropped $1 million into your company. So the second thing that ended up happening is you just established a couple of different valuations. The first one was pre-money valuation. The second one was post-money valuation. Your pre-money valuation is what was your company worth in advance of them investing in you. And what that number, if they're giving you $1 million for half the company, they basically said that your pre-money valuation was $1 million. The post-money valuation is that $1 million that you are worth plus the $1 million that they just gave you. So you now have $1 million in the bank plus your company. Your post-money valuation is $2 million. So that's how that works. And for that, so you've issued an additional 1 million shares that are going to that company. And a couple other things end up happening from there. Number one is, depending on how you structure things, you probably offer them a board seat so that they can make some financial decisions along with it. And so there's an entire new structure of accountability that ends up happening as well. They're now in there. And we'll talk about this as well. There's hopefully you're going to get an organization that's going to be able to help kick open some doors for you, so you can take advantage of all their experience to be able to help accelerate you toward where you need to go. Venture capitalists often have entire fleets of really good managers, and they know how this process works, and they know typically how to make you successful. There's some pitfalls behind that as well, because their primary goal is for their shareholder value, and they want to make sure that they're doing the best return on investment. Part of that is making sure that you're worth a lot. Part of it is just trying to make sure that that investment works out really well. From there, you've got that $1 million and you're going along, and you have a $2 million valuation. 3 months later, a large organization who really sees your technology as being instrumental comes in and says, hey, we'd like to buy you for $2.5 million. You've given up a board seat, so that VC is part of that decision as to whether or not you're going to take that offer. And you might think that that offer is really good, but it's actually pretty doubtful that that VC is going to find that that's going to be very interesting. Just getting a little return on that investment is not what they're all about. They're doing a very high risk investment in you, and for that high risk investment, they want a high rate of return. So if they wanted 5%, 10%, they'd put it just in a normal stock market. They want to double their money, they want to triple their money. They don't want a measly 10, 20% return on investment. Whether you think it's a good idea or not, you're no longer the sole decision maker, and that's one of the problems. So you go down and say a little while later, a year later, you've gotten an offer from another big company that you see as being strategic, and now the offer is for $3 million. Now you're starting to talk about a reasonable return on that investment for them, and let's just say that they say yes. So you're thinking, oh, I had half the company, or me and my buddy had half the company. We get $1.5 million. The VC firm that invested in us got $1.5 million, and no, that's probably not what just happened. What probably just happened is, again, depending on how you had things structured, that investment was not them buying half of your company, like I said before. They're actually giving you a loan, and in return for that loan, they're getting half of the company. First thing that ends up happening is, with that $3 million, you're taking $1 million of that dollars and you're repaying them that loan. Thank you very much. Here's a return, that return. Then, with the $2 million that's left, you get to split that between yourself and the VC firm. So that VC firm gets half of that, half of that money, that $1 million. So for 1 year, they invested $1 million and they doubled their money. That's pretty good for them. For you, you had a $1 million valuation pre-money, and after a year, and after your company basically grew in valuation between $1 million to $3 million, your part of the company is still $1 million. That ends up being one of the things that's really misunderstood about how these investments work is these VC firms are not buying your company, they're not buying your shares. They're giving you a loan, and then in return for that loan, instead of having an interest payment, you're giving them a portion of your company in return. And on their side, that's what makes being a venture capitalist really valuable, is you get those types of returns on investment as opposed to what you would get at Silicon Valley Bank in a savings account. That is just a high level understanding as to how all this stuff works. There's a couple of things I glossed over, like, with that 1 million shares that you started off with, you're not saying, okay, we have 1 million shares, my buddy gets half and I get half because we're joint owners of the company, because you're also going to want to attract some talent inside your organization, so that you're not getting 500,000 shares out of that 1 million shares. You're probably getting maybe 300,000 shares, and your buddy is getting 300,000 shares, and then you're saving 300 to 400,000 shares for other employees that come in, because you're going to need to attract additional talent. And whether or not you even get half of that $1 million that's left over is questionable, depending on how many other people that you ended up attracting. The other thing is that 300,000 shares that you started off with, those have to vest over a period of time, because when a venture capitalist comes in and they take a look at you, if you already own your entire portion of your company, that 300,000, they have no guarantee that you're actually going to stick around. So they're going to want to see you on a vesting schedule just like everybody else. So hopefully, you're going to be vesting over some period of time. And if you negotiate the acquisition correctly, when that company finally does come in, you may be able to have in contractually some accelerators that say you get fully vested if you end up getting acquired like that. Those are all things for you and your attorneys, especially at the time of the acquisition, have to figure out. So it's not as cut and dry as you would think going into this. This is the entire structure of how this process works. I also want to talk to you really briefly about why you would find this important, because you may or may not actually be doing your own startup. Maybe what you're doing is thinking about joining a startup. These are important. All this information I'm going to be sharing is important to you, whether you are one of the founders or whether you're just thinking about joining a startup, because you get to figure out if they're saying, and typically when you join a startup, they say, we can't pay you all that much, but we're going to give you all this stock. However, you press them a little bit on that. Gee, what is that stock actually worth? How many outstanding shares are there? You're giving me 20,000 shares. That's great. Based on how many outstanding shares? And you'll often get crickets. So you really need to understand this before you decide to take your chance and join this company for a lower salary so you can get all these shares. You need to know what those shares are. You also need to figure out whether or not those shares are actually going to be worth anything going forward. Here's a good rule of thumb. Make Crunchbase.com your friend. You can go in and you can take a look at these companies, and for every company that's gotten some degree of angel investment or venture capital investment, etc., you'll often find all those investments kind of registered in Crunchbase. Now, they're never going to tell you this is the percentage of the company that we got, this is the total valuation before or after. All that ends up often being very closely guarded secrets. But you can make some judgment calls, some determinations based on what I've just told you here. Number one is think, when they went through that Series A, they went through that Series B, each time that they did, they probably just assume that they gave away about a third of the company. So if they got an investment for $3 million, that was a third of the company. So, probably the pre-money valuation was $6 million, their post-money valuation was $9 million. And then you go from there to try to figure out what was the next round of funding, And slowly but surely, you start getting this picture of what you think that the company might have been worth. This isn't a hard, fast rule, but it's a good way of kind of thinking about it. And most importantly, if you see that a company just got a round of funding, you know that the chances of them getting bought anytime soon are pretty minimal. And if you take all of the investments that they've gotten in there, remember, all those things are loans. So you take all the investments, the Series A, the Series B, the Series C, and all those things have to be paid off. So you have to figure, okay, so that's probably like a third of the company. Is there a likelihood that the company is going to end up getting sold for 4 or 5 or 6 times more than that combined level of investments in the next couple of years? And if the answer is no, if that's starting to look really kind of doubtful, if you're like, well, this is seems like a really good company, but they've taken in $80 million so far in funding, and they would have to sell for $500 million, $700, $800 million. I don't see that that's going to end up happening. There's a high likelihood that it doesn't matter how many shares that they give you, you may never actually end up seeing that liquidity event at the tail end of it. Your stock may never end up being worth anything, because remember, when that company finally does sell, those are all markers that end up getting paid back to everybody that's invested in there before anybody ever sees a dime of that from a standpoint of a regular shareholder. Use that as a good benchmark to try to figure out whether or not the company is actually viable long-term and whether or not that stock is going to be worth something. There are some things that you can potentially do to try to figure out what the valuation of the company is, and if you're talking to somebody who's never done like a car negotiation at a new car dealership, they may fall for this. But if you ask them, what's the valuation of the company, nobody's going to answer that. But if they're offering you 20,000 shares and you ask them, what's the strike price of this, they may answer that, and then that might give you, again, based on some of those other formulas, it may give you a sense as to what the overall valuation of the company is. If you ask them for how many outstanding shares there are, not immediately ask that after that question, because they'll figure out what you're doing. You might get that answer, and then that may give you an idea as to what the valuation of the company is. But typically you're going to have a really hard time. So the best way is just to try to take a look at the rounds of investment and assume that each one was probably about a third, maybe it was more, maybe it was less. But that's going to give you a sense as to what's going on. And then from there, you can also figure out all those things, all those rounds of investment are actually loans that have to get repaid. And it ends up, giving you an idea as to whether or not there's a possibility that there's going to be a positive outcome regarding the shares that they're offering you. So I hope that you found that helpful and informative. If you did, go ahead, please hit like and subscribe below. If you know somebody who's getting ready to go through a startup, please feel free to forward this out to them if they're going to be able to take advantage of this information. My name is Drew McFarlane, and I look forward to speaking to you next time.